Hello everyone. Today we will practice on chapter 7. Exercise number 1. Company D stock currently sells for $49 per share. The market requires a return of 11% on the firm's stock. If the company maintains a constant 3.5% growth rate in dividends, what was the most recent dividend per share paid on the stock? Alright, cool. This is a very long question. But for now, let's analyze it together. First, we can see the stock is currently sells for $49 per share, which means the price at time 0, the current time, is equal to $49. Next, the market requires a return of 11%. So R, which is the return rate, is equal to 11%. Finally, we know that the company maintains a constant 3.5% growth rate. So G, which is the denotation of growth rate, is equal to 3.5%. And we are asked what was the most recent dividend per share paid on the stock. So when was the most recent dividend took place? Of course, at the current time. So we are asked to answer what is D0. To do this exercise, we first need to draw a timeline. And a timeline could look like this. We are at year 0. And of course, because the stock paid paid a dividend with a constant growth rate every year. So even after 1 year, 2 year, and etc., the G is always equal to 3.5%. So at year 0, we know that the price is equal to $49. The R is equal to 11%. And growth rate, of course, 3.5%. Do you guys see any pattern here? Yes, it is one of the cases that we have studied before in the previous video. In this case, we have to value a stock when it has a constant growth rate. The formula is P0 equal to R, and the formula is P0 equal to D0 times 1 plus G divided by R minus G. Since we already know the number, we can easily find D0. Let's replace it together. So 49 is equal to D0 times 1 plus 3.5. 3.5% divided by 11% minus 3.5%. And after doing some calculation, the final answer is 3.55. Therefore, the most recent dividend per share paid on the stock was $3.55. Company AA is growing quickly. Dividends are expected to grow at a rate of 20% for the next 2 years, with the growth rate falling off to a constant 3% thereafter. If the required return is 10% and the company does pay a dividend of $2.75, what is the current share price? Let's draw the timeline together first. So first we have year 0. And in the first 2 years, so year 1, year 2, we have the growth rate of 20%. So G is equal to 20%. And after year number 2, the growth rate is 3% thereafter. So the stock will pay the same dividend with the growth rate of 3%. So the dividend will grow at the rate of 3% for the rest of the period. Then we know that the required return is 10%. So R is always equal to 10%. Finally, the company just paid a dividend of $2.75, which means D0 is equal to $2.75. For this exercise, it's very interesting. One exercise, but it's a combination of two different valuation models. For the first 2 years is the traditional stock valuation model. But after year number 2, to compute the price of the stock, we have to use the model of constant growth rate. Constant growth rate. Applying the concept of discounted cash flow valuation, we find out that P0 is equal to D1 divided by 1 plus R plus D2 divided by 1 plus R squared and also plus P2 divided by 1 plus R squared. So how do we find P2, D2, D1? Because they are not mentioned in the question. Well, so we know that D0 is $2.75. And at the first 2 years, the growth rate is 20%. Therefore, D1 and D2 is really easy to find. D2 is equal to $3.96 and D1 is equal to $3.3 at the growing rate of 20%. Next, P2. How can we find P2? Just a reminder, this is the constant growth rate model. In this model, the formula is P2 equal to D3 divided by R minus G. But how do we find D3? We need to find D2. And we just found out that D2 is equal to 3.96. And D3 is equal to D2 times 1 plus G here on the timeline, year number 3 here. And starting from year number 2, the growth rate is equal to 3%. Therefore, D3 will be equal to D2 times 1 plus 3% divided by 10%, which is R, minus G, 3%. And we find out that P2 is equal to 58.27 USD. So now we just need to put the number into the original formula that I just wrote over here. And since therefore P0 will be equal to 3.3 divided by 1 plus 0.1 plus 3.96 divided by 1 plus 0.1 to the power of 2. Just a clarification, 0.1 is the R, which is equal to 10%. 10% is equal to 0.1, of course. And we continue with our formula. We plus 58.27 divided by 1 plus 0.1 to the power of 2. Therefore, the final answer will be $54.43. So in conclusion, the current share price is $54.43. I got to say that this exercise is pretty difficult to understand. Not just to understand, but also really difficult to explain. Please stay highly focused on it because it may be a part of the exam. Problem number 3. Suppose we have the following information on a particular company. Earnings are projected to grow at 9% over the next year. What are your high and low target stock prices over the next year? So this exercise requires to find the stock price based on multiple. In this exercise is price to earning ratio and earning per share specifically. So what is PE ratio? PE ratio stands for price to earning. The formula is price of share, of course, divided by earning per share. For example, in year number 1, PE ratio will be equal to $48.6. Of course, in this case, it's for the high price only. 48.6 divided by 2.02. This will get the answer of 24.06. Applying the same concept. P ratio of the second year should be equal to 57.34 divided by 2.31. And we will get 24.78. Price to earning ratio of year number 3, 69.46 divided by 2.45, which is equal to 28.35. And price to earning of year number 4 is equal to 74.85 divided by 3.05, which gives us the answer of 24.54. So for this exercise, we can only forecast the future price because we are asked to answer what is the price of the stock next year, the target stock price. So the keyword is target. Target means we don't even know what it's gonna be yet, and therefore we need to make a forecast. So in the finance world, to forecast the price of the stock in the future, people are gonna look at the price to earning ratio of the previous year. Then they will find the average of the price to earning ratio. In this case, the average price to earning ratio of the previous 4 years is equal to 24.06 plus 24.78 plus 28.35 plus 24.54 divided by 4 years. This gives us the answer of 25.43. And as we know that the forecast, the price is equal to, the price to earning ratio is equal to price divided by the earning per share. Therefore, the price should be equal to P ratio times EPS. And since the exercise said that the earnings are projected to grow at the 9% rate, and the last earning per share in year number 4 was 3.05, so the earning per share potentially of year number 5 is equal to 3.05 times 1 plus 9%, which is the growth rate. And this will be equal to 3.3245%, of course. Sorry, only 3.3245. So if we take the earning per share of year number 5 times the P, the average P, it will be equal to the forecast high price. Therefore, the high price potentially for year number 5 will be equal to 25.43 times 3.3245. And this will be equal to 84.428 dollars. So the same thing should be applied for a low price. And so we find out that the price to earning ratio of low price, of course, year number 1 is equal to 18.44. Price to earning of year 2 is equal to 18.25. Price to earning number 3 is equal to 22.8. And price to earning number 4 is equal to 20.8. Therefore, the average P is equal to 20.07. Next, we need to find out the earning per share. the forecast earning per share. And it is the same, of course. Therefore, it's equal to EPS number 5 equal to 3.3245. And again, the forecast price of year number 5 is equal to forecast earning per share times the average P, which is equal to 3.3245 times 20.07. This will give us the final answer of $66.72. This is the end of our video today. Thank you guys very much for watching, and good luck on the midterm exam.